Hello, everyone, and welcome to Chapter 18, Accounting for Income Tax for Intermediate Accounting 2. In this video, we're going to be doing step number 3, which is loss carryback and loss carry forward. Yeah, so just a recap of what we've done so far for Chapter 18. We did step number 1, which was determine the taxable income and current tax expense for the year. So there you would start with net income, adjust for your permanent and temporary differences. That will get you your taxable income. Multiply that by the current tax rate, and that will give you the current tax expense for the year. And then you can do your first journal entry, which is debit current tax expense, credit income tax payable. Then the second step in this video number 2 was determine the deferred tax asset liability and the deferred tax expense or benefit for the year. So here you just take the temporary differences and put them in the deferred tax schedule and figure out if you're going to be saving more tax in the future, you're going to record an asset. If you're going to be paying more tax in the future, you're going to record a liability. Okay? So that would be your second journal entry. And then today we're going to be doing, for this video, going to be doing accounting for tax losses. Okay? So if you've taken a tax course yet, then you would know that you can carry back and carry forward your tax losses. Okay, so when you calculate your taxable income, so you start with accounting income and add and subtract your permanent and temporary differences, you're going to get taxable income. So for this video, we're looking at what if that taxable income is a loss instead? What if it's a negative number? So after you've done your calculations, after step number 1, if you get a negative number, what happens? So that's what this video is for. If you get a negative number, you do not pay tax on a loss. So you won't have a current tax expense. So your current tax expense will be 0. But under the Income Tax Act, we can do something with the loss. Having a loss for accounting income is pretty bad. Like if you show financial statements and you show a loss, that doesn't really signify good things for your company. But if you have a loss for tax purposes, you can actually use those losses you can either carry them back or carry them forward and pay less tax in the past or less tax in the future. So for those of you who've done a tax course, probably know how many years you can carry back a loss. Okay? So to carry back a loss, you can carry it back 3 years. So you can carry back a loss 3 years. Okay, so if you have a loss in year 4, for example, you can carry it back to the past 3 years and bring down your taxable income for the past 3 years and be able to claim less taxes. So the taxes that you would have paid for those 3 years, you can get a refund for some of that. And then how many years can you carry forward losses? You can carry forward losses 20 years. Yeah, so you can carry forward losses a big 20 years. So that means if you have a loss in year 4, you can carry it forward and use it in the next 20 years to offset any income that you've received. Taxable income. So let's take a look at how you do this. Okay? So when you're looking at the year of a loss, so if you have a loss in a particular year, then what you're going to do first is determine, okay, can I carry back this loss? Is there any income in the last 3 years that I can carry back this loss to and reduce my taxable income in those 3 years and evidently pay less tax? Okay? So first thing you want to do is see if there's any income that you can carry back. And you want to do this first because you're going to lose out, because you can only carry back 3 years. So you're going to lose out on that if you do carry forward first, for example. You can do carry forward for the next 20 years. So you have a lot of time to carry forward, but the carry back, you're only going to be able to use up 3 years worth. So you want to try to carry back first. Then what we do is after you've carried the loss back and used it to offset the income in the last 3 years, check if you have any loss left over. So if you have any loss left over, then you would do number 2, which is the carry forward entry. But you can only do it if it's probable or likely that the loss will be used in the carry forward period. Okay? So if you have a huge loss and you don't think you'll be able to use that loss in the next 20 years, then you actually can't record it according to IFRS and ASPE. You would have to just not do the carry forward entry, but you can still use the loss going forward. If it's not likely or probable, like I said, there would be no entry for carry forward. You would just do the carry back entry first. So you would look at the projections to determine, is there going to be enough income in the next 20 years where you can use the loss that you had in the current year. So let's look at an example to make sense of these steps. Okay, so I put together an example here of 5 years of taxable income for this one company. So the taxable income for 2015, 16, 17, 18, 19. So the taxable income is after step number 1, right? You figure out your net income, adjust for temporary permanent differences, and you get taxable income, multiply by the tax rate, and it's your current tax expense for the year. Okay, so assume that step number 1 has been completed for 2015, 16, and 17. So let's assume that we are in 2018 right now. Okay, so we're in the year of a loss. So we're in 2018 right now. We've already had some income in the past 3 years. 2015, let's say 2015, actually no, that doesn't matter. Okay, so 100, 200, 300, but then something happened in 2018. We had a really bad year. We had a loss, a taxable loss of $1 million. So if you have a taxable loss, you do not pay income on your, sorry, you do not pay tax on a loss. So you're not going to have a loss here. So that's going to be 0. So it's not like you have to multiply these two together, and you wouldn't have a journal entry for current tax expense for 2018. Okay, so no journal entry for current tax expense, which is the last step of step number 1. So what you're going to do is you're going to look at this $1 million and say, can this be carried back? Okay, so first thing you do is see, can this be carried back 3 years? And you want to go to the furthest year possible first, because once we get to 2019, we're going to lose out. Like, we won't be able to claim anything from 2015 anymore, because in 2019, the last 3 years are 2016, 2017, 2018. Okay. So we want to go all the way back first to see if we can use some of this loss to offset this income. So we would have $1 million of a loss. We have $100,000 of income. We can definitely use the $1 million to offset this 100,000. So if we took our loss to offset this 100,000, we wouldn't have taxable income of 100,000. We would have taxable income of 0. 0 multiplied by the tax rate gives us 0 as our current tax expense. So therefore, if we use our $1 million loss to offset our $100,000 income we had in 2015, we essentially don't have to pay this $27,000. We would have already paid this $27,000 in 2015 or early 2016. So what we're going to do is we're going to end up getting a refund for this amount. So we're going to have to file the tax return to show that we're using some of our loss to offset all of our taxable income in 2015. And therefore, we're going to get a $27,000 refund. Let's do the same thing for 2016. So we've used up, okay, so if we have $1 million of a loss available, so we have $1 million of a loss. Okay. Now we've used up 100,000 from 2015. We still have $900,000 left. So let's see if we can use that in 2016. So 2016, we have taxable income of 200,000. We have $900,000 of a loss left over. So we can definitely use some of that loss to offset this income. This income can be offset to 0. Okay, so we can offset this to 0 because we have $900,000 available. So we can get rid of all of this 200,000. Which means we no longer have to pay that $56,000. We've already paid it, so now we're going to get a refund for that $56,000. Okay, so now we've used up 200. So we've used up 100. We've used up 200. So 300 minus $1 million, we have $700,000 of a loss left over. So we have $7,000 left over. Let's see if we can use it in 2017. So 2017, we had taxable income of 300,000. we have $700,000 of a loss left over, so we can use that 700,000, offset all of that 300. Okay, so we offset all of that 300, make that 0, which means we wouldn't have to pay this 87,000. We already paid it, so we're going to get a refund. Okay, so we've used up now another 300. So we've just carried back as much as we could of our loss. Okay, so we had $1 million, we carried back 100,000, 200,000, 300,000. So we've carried back 600,000, which means we have a loss available of 400,000 that we can carry forward. Okay, so we'll carry forward this 400,000, so carry forward. Right now we're in 2018, so we don't know what's going to happen in 2019 yet. So let's just ignore this 2019 because we're not sure. We're in the 2018 year right now, but we know that we have 400,000 of a loss left over that we can carry forward for the next 20 years. Okay, so you do the carry back entry first. Take a look at how much we have to get a refund. So we wouldn't, if we took our loss and allocated our loss to all of 2015's income, all of 2016's income, all of 2017's income, we wouldn't have to pay this 87, 56, and 27. Therefore, we're going to get a refund for all these three amounts. So we just need to do one journal entry for the total of the carry back amount. So we don't have to do a separate journal entry for each one of these because in 2018, we're going to file this and ask for a refund for all of these years together. Okay, so if you add up how much tax you had to pay for these 3 years when you did have taxable income, and now we've allocated 0 as our taxable income, which means we no longer have to pay these amounts. So if we add up the 27,000, 56,000, 87,000, we're gonna get a refund. We're gonna get a refund of 170,000. So if you add up all of those amounts, it comes up to 170,000. So that's how much of a refund we're going to get because of the fact we allocated our $1 million loss to all of our incomes in 2015 to 2017. Okay, so let's look at the first, how you do this journal entry. So we're going to do a journal entry for the refund first, which is our carry back entry. So number 1 is our carry back entry. We're going to debit income tax receivable. So usually what we do is when we have to pay tax, we credit income tax payable, but now we're going to get a refund for this amount. So we're going to debit income tax receivable. Okay, so 170,000 will be your income tax receivable, and then we're going to credit current tax expense or benefit. So in this case, it's a credit amount, so it's a benefit. So that's your carry back entry. Because we're going to get a refund for those 3 years, the tax we originally paid for those 3 years, we're getting a refund back. So 170,000, and our current tax expense, 170,000, our current tax benefit actually. Okay. All right, so that is part 1 of the 2 journal entries you would do in a year of the loss. So let's go back to our example. We said we had $400,000 available to carry forward. So we had $1 million at the beginning. We got rid of, we used up 100, 200, and 300. So now we've used up 600,000 of the 1 million. So we have $400,000 to carry forward. So you can only do a carry forward entry if it is probable or likely that you'll be able to use this loss in the future, okay, in the next 20 years. So we were making some income in the past 3 years. We did have a bad year with $1 million of a loss, but we don't expect to have another bad year like that, or not for the next 20 years. We expect to make more than $400,000 of taxable income in the next 20 years. So therefore, we will be able to carry forward this loss. So if it is likely or probable that we can carry forward this loss, then we can do our second journal entry. So we take the total amount of our loss and multiply it by our tax rate. Okay, so right now we know that our tax rate is 30%. So we're going to take 30%, multiply by 400,000 of a loss left over, and that's going to get us how much we carry forward. So so that's 120,000. So our carry forward journal entry, we're going to debit a deferred tax asset because because we have this loss that we can carry forward and pay less tax in the future, we're going to record an asset. Okay, so you're going to have a deferred tax asset for step number 2 and a deferred tax asset for step number 3. So if we have a loss that we can use up in the future to bring down our net income, that's a deferred tax asset. And then we're going to credit deferred tax expense, or sorry, deferred tax benefit. Okay, so we have a benefit in the first journal entry, benefit in the second journal entry. So there is a benefit to having a tax loss. All right, so that's the year of a loss. Those are the 2 journal entries in a year of the loss. So let's take a look at what happens in the year following a loss. So we said we had $400,000 of a loss that we can carry forward. Right? So now let's say that we're in 2019, in the year following a loss. In 2019, we picked ourselves back up. We made $500,000 of income. So at this point, we get our taxable income. We know that we have a loss left over of $400,000 that we can use, so we can use it here. So if we had $500,000 of taxable income, let's use the whole loss. Let's get rid of this or use this all up, because we don't know what's going to happen in the next few years. Maybe we'll have another loss in 2020 that we can use in the future. So if we have this loss available, let's use it all up. Okay, so if we use up all of our $400,000 loss to offset our $500,000 income in 2015, then in 2015, instead of our taxable income being $500,000, so if you minus the $400,000 loss, then we're going to have taxable income of $100,000. Okay, so if we're allocating our loss, our taxable income goes down to $100,000. So it doesn't go down completely to 0 like these previous years did, because we only have $400,000 loss left over to carry forward. So if we only have a taxable income of $100,000 multiplied by the tax rate, we don't have to pay this $155,000 that we thought we had to pay. We only have to pay $31,000. So let's assume that we didn't do our journal entry for the current tax expense of $155,000 yet, because we know that we have this loss. So we wouldn't have done our first journal entry because we know that we have this loss that we're going to allocate, and we're only going to pay $31,000 of taxes instead of the $155,000 we would have paid if we were paying it on the full $500,000. So we used up all of this loss. So we're going to have to get rid of our asset account, our deferred tax asset, and we're going to record this $31,000 that we have to pay. So in the year following a loss, we're going to use the loss and record the entry for current tax expense. If there is any tax to pay after applying the loss, and then we're going to reverse defer to a tax account if we've used it. Okay, so for the years following a loss, the journal entries, first journal entry, we're going to use the loss to bring down our income tax expense. So we're only paying $31,000 instead of that $155,000 that we thought we would have to pay, because we had that $400,000 of a loss that we used up. So we're going to debit current tax expense for only $31,000, and we're going to credit income tax payable for $31,000. So this is assuming that we didn't do our first journal entry in step number 1 of the $155,000 yet. If we did, then we would just bring down that $155,000 to the $31,000. And then our second journal entry, because we've used up our deferred tax account, deferred tax asset account, because now we don't have any more of a loss left over because we've used it all in 2019. So because we've used it all, we have to get rid of that asset account. So if you remember, we had a carry forward, we recorded an asset of $120,000, but now we've used it all up. So we have to get rid of it. So we're just doing the reverse entry that we did previously. So we debit deferred tax expense and credit deferred tax asset $120,000. If we didn't use up all of the loss, we wouldn't have to get rid of all of the asset. We would only get rid of the asset portion that we've used up. And I'll show you when we do the Excel example of how to record that. Okay, so just one complication to this. So ASPE uses what's called a valuation allowance method. This is just for ASPE, and ASPE has a choice whether to record the journal entries the way that I just showed you, or to use the valuation allowance method. So under ASPE, the valuation allowance method says that the full amount of the carry forward benefit is recorded, and any amount that cannot be realized is recorded through a contra account called allowance to reduce future income tax asset to expected realizable value. Very long account. We can just call it allowance just to make it easier. So like I was saying before, when you have to carry forward a loss, you would only do the journal entry if it's likely or probable that we can realize that loss in the future. Sometimes only a percentage can be realizable. So if they had the $400,000 loss and thought, we only think that $200,000 of this can be realized in the future, we would only record a journal entry for $200,000. But under the valuation allowance method for ASPE, we're going to record the full amount of the carry forward benefit. It doesn't matter whether it's likely or not, we're going to record the full amount. So debit your deferred tax asset, credit your deferred tax expense or benefit. And then we're going to create a contra account for any carry forward amount that cannot be realized. So if none of it, if it's not probable that any of it can be realized, then we're going to have an allowance for the full amount of the carry forward benefit, which is going to end up bringing down your total balance. Okay, so what this is going to look like on the balance sheet is you're going to have your deferred, so you're going to have your deferred tax asset account, and that's going to be the full amount of the carry forward benefit. And then you're going to have this allowance, which is going to be your contra account right underneath it. And your allowance is going to decrease your deferred tax asset to whatever can be realized, so whatever is probable. So the probable amount is going to be this last number. The deferred tax asset is going to be the full amount, and then do your allowance for anything that they think that cannot be realized. So this could be the full amount, which means that this would be 0. Or it could be 50%, or it could be 70%. It's going to depend on what the question says. Okay, so we're going to look at a question like this, and also I'll show you what that looks like. And then the last thing I want to show you is the income statement presentation. So in a year of a loss, so if we go back to our journal entries for the year of a loss, whatever hits the income tax expense or benefit account. So we had a current tax expense of $170,000. That was a benefit, so it's going to actually bring down our loss. And then we had a deferred tax benefit of $120,000. So this 170 and 120 is going to bring down our total loss. So let me show you the income statement presentation there. So we have $1 million of a loss in 2018. We had a benefit due to loss carryback of 170. We had a benefit due to loss carry forward of 120. So that's going to bring down our loss to 710,000. So our net income after tax, or net loss after tax, is 710,000. So that's a year of a loss. For the year following a loss, we did these two journal entries. We debited current tax expense 31,000, deferred tax expense 120,000. So if we look at that, we had income of 500,000 before we allocated our loss. So for this example, we're going to assume that accounting income and taxable income are the same. Okay, so just pretend that accounting income and taxable income were the same amount, so 500,000. We have a current tax expense of 31,000, deferred tax expense to 120, which brings down the net income to 349,000. So that benefit we got from having a tax loss is not recognized in 2019 because it was already recognized in 2018 to bring down this loss. Okay, so in order to bring down, we had a net loss of 710 instead of 1 million. So that is shown in the year of a loss because that's when it happened, not in the year following a loss. Okay. If it is not likely or probable that if we're using IFRS or using ASPE, that without the valuation method. If it wasn't probable or likely that we can use the loss carry forward, we wouldn't record a loss carry forward. So we'd only record the journal entry for carry back. We wouldn't do carry forward. But we can still use the loss to bring down our current tax expense. So in 2019, we're still using our loss to bring down this to a 31,000 because for the Tax Act says if you have a loss, you can use it. IFRS and ASPE say you can't recognize the benefit for this unless it's probable or likely, because we're going to be recording an asset. So when it comes to accounting is conservative. They don't really like recording assets unless it's probable or likely that they will be able to get the amount or be able to realize that asset. Okay? So we can still use the loss, but we can't record the asset if we thought it wasn't going to be probable or likely. All right, so now let's go look at some exercises. So if you go to the Excel, chapter 18, step number 3. So we have 2 questions here, question 1 and 2. So I'll walk through these questions step by step. What you should do now is pause the video and do question 1 on your own, try it on your own, and then resume the video to see how it's taken up. And then you can try question 2 on your own, pause the video, and then you can watch the take up. Okay, so Riley Inc. reports the following pre-tax amounts for both financial reporting and tax purposes. So it's saying for both financial reporting and tax purposes. So this accounting income is also the taxable income. So I'm just going to put accounting and taxable income. Okay, so just to make it simple, we're going to say that the accounting income and taxable income are the same for this example. So 2012 to 2015 was 120, 90, 280, 220. So we have a loss in 2014. Okay, so let's just remember that we have a loss in 2014, and then these are the tax rates. So question A says, prepare the journal entries for each of the years 2012 to 2015 to record income taxes, assuming that the tax loss is first carried back at the end of 2014, and then the carry forward are more likely than not to be realized in the future. Okay, so we're saying that we can do the carry forward entry because it is more likely than not that it's going to be realized in the future. Okay, so let's work on part A. Okay, so it says prepare the journal entries for 2012 to 2015 to record income taxes. Okay, so in 2012 we had income of taxable income of 120,000, tax rate was 34,000. I'm just going to move this over. Actually, I'll leave it. Okay, so 120,000 times a tax rate of 34%. So in 2012, we have to pay 40,800. So it wants us to do all the journal entries from 2012 onwards. 2012, we had income. So if you look at 2012, we're going to do current tax expense, income tax payable, 40,800. So this is basically step number 1's journal entry. Okay, so you would have done that in step number 1, current tax expense, 40,800, income tax payable, 40,800. We're going to do the same thing in, use a different color actually. We'll do the same thing in 2013. We had income, 34%. So 90,000 times 34% gives us 30,600. I'm just going to make this a different color so you can see which is the question, which is not. Right. Okay, so same thing in 2013. We're going to have current tax expense, debit, income tax payable, credit, 30,600. Okay, so again, these 2 journal entries are from step number 1. In 2014, this is the year of a loss. So what we're going to do first, so in the year of a loss, the first thing you do is do your carry back entry. Okay, so we're going to look at 2012 and 2013. So we're going to carry back 3 years, but we only have data for the last 2 years. So maybe this company only started its operations in 2012, which means that we would just have to go back 2 years. Okay? So we have a $280,000 of a loss in 2014. We need to see if we can carry back this loss to offset our income, taxable income in 2013 and 2012. Okay, so let me just do the calculation here. So in 2014, we had a loss of 280. Okay. In 2012, we had income. So let's go back to the earliest year. So 2012. So here we have income of 120,000. So we have enough. We have $280,000 of a loss. We can offset all of this income, which means we're gonna say that that's 0. Okay. So if we offset all of that means that's 0, and that means we wouldn't have to pay this $40,800 that we have already paid. Okay. Same thing for 2019, actually, sorry, 2013. Let's see how much we have left first. So let's see how much we have left. So we have a $200,000 loss. We just used up 120,000. So, oops. So let's see how much we have left. We have $160,000 of a loss left over. So we can definitely use it to offset this 90,000, right? So this 90,000 can again go down to 0. Okay, so I'll get rid of this 90,000. That's going to be 0, which means we wouldn't have to pay this 30,600. All right, and then do we have any loss left over to carry forward? Let's take a look. So we've used up 160. Let's see. So we've used up 160. We've used up 90. How much do we have left over? So we have $70,000 of a loss left over that we can carry forward. Let's deal with a carry back entry first. So because we've gotten rid of the 120, the 90, we wouldn't have to pay this 40,800, 30,600 anymore. So we're going to get a refund for these two amounts. Okay, so if we add up these two amounts, we're going to get a refund of 71,400. Okay. So let's look at the journal entry there. So for 2014, the journal entry is debit your income tax receivable, 71,400, credit our current tax benefit of 71,400. Okay, so we don't have to pay that tax anymore because we've allocated our loss to those 2 years. Therefore, we're going to get a refund of 71,400. All right, the second entry in 2014 is to use or to do the journal entry for this carry forward amount. So we have $70,000 that we're carrying forward, and it says that it is more likely than not that this loss can be realized in the future. Therefore, we can record the carry forward entry. So we're going to do a carry forward entry for a deferred tax asset, and we're going to use the 2014 tax rate. So we're going to do 70,000 times our tax rate, and we're going to be recording a deferred tax asset of 26,600. Okay. So into the second journal entry, we're going to debit deferred tax asset 26,600 and credit deferred tax benefit 26,600. So the year of a loss, we do our carry back entry first. And then if it is likely or probable that we can use up the loss in the future, the carry forward amount, then we can set up our carry forward entry. All right, so let's look at 2015 now. So 2015, we have income of 220,000 with a 38% tax rate, but we know that we have a bit of a loss that we can use for this. Okay, so we have 120,000. We have a $70,000 loss. So if we allocate that $70,000 loss, okay, so we no longer would have 220 as our income. If we take 220 minus the 170 that we have, we get income of 150 instead. Right? So we only have to pay tax on 150 instead of paying tax on the 220. 150 times the 38% is going to get us current tax expense of 57,000. So I have that all here. All right, so 220 minus the 70,000 of the loss that we had from previous year gives us 150 times the 38%. So we only have to pay $57,000 in tax instead of what we thought we had to pay. So just clear this. Yeah, so if we had to pay the full amount, we would have to pay 220 times 38%, which would have been 83,000. But we no longer have to pay that. We only have to pay 57. So our first journal entry in the years following the loss is you're going to record this 57,000 that we have to pay in 2015. So current tax expense debit, income tax payable credit, and that's 57,000. And then our second journal entry we have to do is we have to use up the loss, the asset, right? So we had recorded an asset in 2014 of 26,600, but we've used all of this up because we've used all of our $71,000 of, $70,000 of loss. So therefore we have to get rid of the asset because we no longer have this benefit. So we would debit deferred tax expense, credit deferred tax asset, just the reverse entry that we did in, reverse the entry that we did in 2014. Right. Okay, so I hope that makes sense for part A. Let's look at part B. Part B says, prepare the journal entries for 2014 and 2015, assuming that it's more likely than not that 25% of the carry forward benefits will not be realized. The company does not use a valuation allowance method. So they're saying that out of this $70,000 of carry forward that we've calculated, the company thinks that 25% we will not be able to use. So it's only probable that 75% of the 70,000 will be used. Okay? So we can only record the journal entry for the deferred tax asset of 70,000. So all the other journal entries from 2012 to 2015, sorry, 2012, 2013, the first journal entry for 2014, those are all the same. So we can do the carry back entry, no problem. But for the carry forward entry, we have $70,000 of a loss left over. They're saying that 25% will not be realized. So they think they can only realize 75% of this loss. So the deferred tax asset we recorded in 2014 of 26,600, we need to bring that down by 25% because it's assumed that 25% will not be realized. So we can't record the full amount of the asset if we don't think we're going to realize the full amount. Okay, so in 2014, we can just do it here. So 26,600. So we're only going to be able to realize 75% of it. Okay, so we're going to multiply it by 75%. And that's going to give us 19,950. So we're only recording an asset of 19,950 because it says here that only 25% will be, 25% will not be realized, which means 75% will be realized. Okay, so the journal entry, debit deferred tax asset, 19,950, credit deferred tax benefit, 19,950. Everything else stays the same. It's just that we're only recognizing 75% of the asset. In 2015, we can still bring down our current tax expense to $57,000 because we do have the loss. So we can use up all of the $70,000 of the loss like we did in part A. But for deferred tax expense, for a second journal entry, we only recorded an asset of $19,950. So we're only going to reverse the $19,950 because that's all we recorded in 2014. Yeah. So that's how you deal with if the benefits cannot be realized or some of the benefits cannot be realized. Let's go up to part C. How will the entries be different in part B if the company did use the valuation allowance? So again, the valuation allowance method is only allowed in ASPE. It's an option under ASPE that can be used. So in this case, we know that 25% of the benefits will not be realized. So we're going to set up a deferred tax asset for the full 100%. And then we're going to set up an allowance for the 25%, which at the end will have us report a total asset of 75%. So let's look at those journal entries. So part C, our refund receivable is the same. We're going to record our deferred tax asset for the full amount, 26,600. Then we're going to have an allowance account to reduce the 25%. So you take 26,600 times the 25%. I'm sorry, that's going to give us 6,650. So that's how we get to that number. So whatever cannot be realized is going to go into this allowance account. So like I showed you before, we're going to have on our balance sheet, we're going to have our deferred tax asset of 26,600. We're going to have allowance of 6. It's going to be a negative because it's a credit. Okay, so that's what our balance sheet's going to show up as. And then the net amount is going to be 19,950, which is exactly what we want, is exactly what we showed in part B. And then 2015, so then what happens in 2015, we've used up all of our asset. So we have to get rid of our asset, and we also would have to get rid of our allowance account, because there's no point, we're not going to have an allowance account if we don't have an asset account anymore. So in 2015, because we've used all of the loss, we're going to get rid of this asset account, and we also are going to get rid of this allowance account because they work together. So you can't have one without the other. Okay, so we're going to debit deferred tax expense, credit our asset, 26,600, debit our allowance, and credit deferred tax benefit, 6,650. So we have to get rid of both those. So we made 2 journal entries related to the asset. We've used up all of the asset, so we have to get rid of the asset and the allowance. All right, and then part D says, using the assumption in part A, prepare the income statement sections for 2014, 2015. Okay, so part A said that we were allowed to record 100% of the benefit of the loss. So let's see what the income statement presentation is like. So we had net income before tax for 2014 of 280,000. We had a loss of 280,000. And then the 2 journal entries that we did in part A of 2014 was we credited current tax benefit of 71,400 and credited deferred tax benefit of 19,950. So those 2 amounts are going to bring down our loss. So if you add up those 2 amounts, 98,000, we're going to bring down our loss to 182,000. Yeah, so instead of a loss of 280, it's a loss of 182,000 because we took advantage of the loss that we had and used it in the prior periods and carried forward some of it. Then in 2015, we had total income of 220. And then we can see the 2 journal entries that we did in 2015. We debited current tax expense of 57,000. We debited deferred tax expense of 26,600. So those 2 amounts will show up in our income statement. So 57,000, 26,600. These are both expenses, so it's going to bring down our income to our net income would be 136,400. And then lastly, part E says, using the assumption in part B, prepare the income tax section for 2014 and 2015. Okay, so we do the same thing. We just look at what are the journal entries that we did in part B, what hit the tax expense, and then put that in your income statement presentation. So part B I'm sorry, I was showing. Sorry, for part D, we should have been looking at these numbers here. Sorry. And then for part E, we're looking at these numbers. Okay, so 71,400, 19,950 were the two journal entries in 2014. Okay, so 71,000, 19,950. Those two amounts are going to bring down our loss because they're benefits. So our loss is 188. In 2015, under the part B journal entries, we had two journal entries, 57,000 for income for current tax expense and 19,950 for deferred tax expense. So those two are right here. That's going to bring down our income because they're both expenses. So we have a net profit of 143.50. All right, so I hope that was a long question, but I hope that makes sense for all the different types of things we have going on here. So let's do another question just to make sure you guys are okay with these journal entries. So question number 2. So it'd be a good idea for you to pause this video right now and try question number 2 on your own, and then play it again and find out if you were close or correct on the journal entries that you did. Okay. All right, so let's take this up. So this company reports the following income and losses for both book, so accounting and tax purposes. Assume that we're going to do the loss carry forward wherever we can, sorry, loss carry back wherever we can. Okay, so it's saying for both books and tax. So this is accounting income and taxable income, just to make this easy to follow. All right, so part A says, prepare the journal entries for each of the years 2011 to 2014 to record income taxes, assuming that at December 31st, 2013, that it was that the company would not benefit from the remaining losses available to carry forward. Okay, so the company would not benefit, which means that it's not probable or not likely that they will be able to use the losses in the future. All right, so let's see the journal entries. So they want us to do the journal entries for 2011 to 2014. Okay, so 2011, assuming that the journal entry for step 1 was not done, we had 140,000 of income. Our tax rate was 25%. Okay, so we're just going to record our current tax expense of 35,000. Okay, so 35,000 in 2011. The journal entry there, current tax expense 35,000, credit income tax payable or current tax payable 35,000. Same thing in 2012, we had $65,000 of income. Our tax rate was again 25%. So we ended up paying $16,250 for our tax in 2012. So then we would have had a journal entry, debit current tax expense, $16,250, credit income tax payable or current tax payable, $16,250. Okay, so some companies call it income tax payable, some call it current tax payable. As long as it's showing a tax payable, it's fine. All right, now let's go to 2013. 2013, we have a loss of 290,000. So we know we don't have to pay any tax in 2013, but we need to see if this 290,000 can be carried back. We carry it back 3 years. We only have 2 years of data, which probably means that the operations only started in 2011. So let's see if we can carry it back to 2011. So we have $290,000 of a loss. We had $140,000 of income in 2011, so we can definitely carry that 290 back. Okay, so I'll just write it here. So 290, and we want to allocate the 140. Okay, so we can totally do that. So the 140 is gone, 0. 0 times the tax rate is 0, so we no longer had to owe that 35,000. We've already paid it, so we're going to end up getting a refund for that. All right, so how much much of a loss do we have left after we allocate the 140? So let's see. So we had 290. We used up 140. We have $150,000 left. We only had income of $65,000 in 2012, so we can definitely use that 150 that we have left in 2012 and bring the 65 down to 0, which means instead of paying $16,250 of taxes, we no longer owe that, we owe 0. We've already paid this, so we're going to end up getting a refund. All right, so we got rid of 140, we got rid of 65. Okay, so let's see how much of a loss. Do we have any loss left over that we can carry forward? Let's see that. Yes, we have $85,000 of a loss that we can carry forward. All right, let's do the carry back entry. So instead of paying $35,000 and instead of paying $16,250, we're no longer paying that. So we're going to get a refund for those two amounts. So let's see what the refund's going to be. So if we sum these two amounts, we get $51,250. So we're going to get a refund of $51,250. So let's do that journal entry for 2013. So 2013, we have a journal entry debit income tax receivable, $51,250 for the refund, credit current tax benefit at $51,250. We usually do a second journal entry in 2013 for the carry forward amount, but Part A says, assume that the company would not benefit from the remaining losses available to carry forward. Okay, so the company doesn't think that they'll be able to use up this $85,000 of a loss to carry forward, so therefore we're not going to do the carry forward entry. So we're only going to do the one journal entry in 2013, which is our refund amount for carryback. We're not doing a carry forward entry because our question says that we would not benefit from the remaining losses available to carry forward. All right. Okay, so Part B says prepare the income tax section for 2011 to 2014, beginning with net income or loss before income tax. So it wants us to do the income statement presentation for all of these years. Oh, sorry, we forgot to do 2014's journal entries first. Okay, so we missed out. So 2013, only one journal entry because the question says we can't, it's not probable or likely that we can use this 85,000, so we're not going to record the journal entry. So now we get to 2014. We have income of 40,000. We do have an $85,000 loss available. We have income of 40,000, so we can definitely use this 85,000 to get rid of all of this loss. Okay. So we're going to get rid of all of this loss, which means we pay 0 taxes. Okay, so in the last question, we'd had some amount left over after we had used up all of the loss and had still some net taxable income left over in the year following a loss. This time we're using up all of it, so we don't actually have to pay any money in 2014. So the first journal entry is supposed to show how much tax we owe. We don't owe anything, so we wouldn't have a journal entry for current tax expense or income tax payable. So we wouldn't need to do a journal entry there. We've used up some of the loss, right? So we have $85,000 of a loss left over. We used up $40,000 of it. So we actually still have some loss left over to carry forward for another year. So we have $45,000 left that we can carry forward to the next year or the next 20 years. But we never recorded an asset for 2013, so we're not going to reverse our asset because we didn't record anything. Even though we didn't record a deferred tax asset in 2013, we can still use a loss to bring down our income. So we thought it was unlikely that we would be able to use it, but it turns out it was, and we were able to use it, so we can still bring it down. Now let's do the income statement presentation for 2011 to 2014. So net income or loss before taxes, or current tax expense, current tax benefit. So just look at your journal entries, right? Whatever hits the expense. So here we had current 2011, we had current tax expense of 35,000. So that brought down our income to 105 in 2011. In 2012, we had income of 65,000. We paid current tax expense of 16,250. That brought down our net income. In 2013, we had a loss of 290,000. And then we did this current tax benefit for a refund of 51,250. So that showed up here. That's going to bring down our loss to 238,000. I think these signs are going to confuse you because I had them the other way around in our last one. So this probably should be, well, it's up to you of how you do the signs as long as you have the right net income at the end. Okay, so the $51,000 of a benefit is going to bring down our loss. And then 2014, we didn't have any journal entries. So we had income of 40,000, no taxes paid, which means our income stayed at 40,000. All right, so let's go to part C. So part C says prepare the journal entries for 2011 to 2014, assuming that it was that the company would benefit from the remaining losses available to carry forward. So part A said would not, part C says would. So we are allowed to record this carry forward amount. Okay, so we didn't do a journal entry for the carry forward in part A, but we're going to do it in part C. So everything else remains the same, except we're doing our carry forward entry. So in 2013, we're doing our carry forward entry, deferred tax asset, deferred tax benefit, 25,500. I'll show you where you get that number from. So after 2013, we had a loss. Let me just bring this down. So 2013, we had a loss that we could carry forward of 85,000. We multiply that by our tax rate, because our deferred tax asset account is always after tax. Oops, sorry. Okay, so we always do an after tax amount. So we always have to multiply it by the tax amount. That should be a number. All right, so that's a mistake that I see a lot, that people put the journal entry for 85,000 instead of multiplying it by the tax rate and making it 25,500. Okay, so make sure you don't make that mistake. So we can record a deferred tax asset of 25,500 and a deferred tax benefit of 25,500. The first journal entry in 2014 stays the same as part A. We brought down our 40,000 to 0, which means we didn't have to pay any tax for 2014. So we actually don't need a journal entry, our first journal entry. I'm just showing this to you, but you don't need that. But we used up some of our deferred tax asset, so we have to get rid of some of our deferred tax asset. We didn't use up all of it like we did in the last question. In the last question, we had used up all of that 26,600, so we reversed all of it. But here, after we take into account that, move this. So after we take into account the 40,000 of taxable income that we had in 2014, we still have a loss left over of 45,000 that we can carry forward in the future. So we didn't use all of that loss, which means we don't have to get rid of all of the asset. So since we used up, so the 40,000 times the 30%, we used up $12,000 of this. Okay, so we used up $12,000. So therefore, we only record we only get rid of $12,000. So debit deferred tax expense, credit deferred tax asset, $12,000. Another way to get to this 12,000 is to see how much do you want left in your deferred tax asset account at the end of the year. Okay. So at the end of the year, we have $45,000 left to carry forward. If we multiply this by the tax rate, and it's going to be your current tax rate, we still need to have $13,500 in our deferred tax asset account. We had $25,500 in our deferred tax asset account. We need to have $13,500. Okay, so if we do a quick little T account, so if we have a deferred tax asset account, we started off with a balance of $25,500. We need a balance at the end of $13,500. So what do we have to credit in order to get there? So we have to credit $12,000. So if you do 25,500 minus 13,500, you get $12,000. Okay, so that's how much we would have to credit. So you can do it that way, or because we have the same tax rate, we can just take the 40,000 multiplied by the 30%. Either way, we'll get that 12,000. Okay, so we get rid of $12,000 of the asset. Debit deferred tax expense, 12,000. Credit deferred tax asset, 12,000. The last part says prepare the income tax section for 2011 to 2014. So just doing this again, 2011, 2012 are the same. For 2013 and 2014, we just have this extra journal entry that we did. We did deferred tax benefit of 25,500. We add that there. That's going to bring down our loss. And then we had this deferred tax expense, 12,000. That's going to bring down our income to 28,000. So the only difference between Part D and Part B is Part B, we only recorded the one journal entry for each of 2013. 2014, we didn't record any journal entries. But in Part C, we had to record the asset, deferred tax asset, and we had to get rid of some of the deferred tax asset. That's where these two come in. All right, so I hope these couple examples made some sense. That is chapter 18. So 3 steps, 3 videos for chapter 18. And now you should be good with chapter 18. Okay. Thank you for listening and take care.